Good day. We're going to talk now about the basic principles in working capital management. The working capital management is part of the overall management of the statement of financial position. It is related to the short-term assets and short-term liabilities. It being short-term should be determined as to their relationship with time. Short-term investment relates to the rate of return on investment, while short-term liability relates to the interest rate paid for the short-term obligation. The relationship between rate and time on the short-term items is shown on the following graph. It is positive and upward sloping. It means that if the length of time is reduced, the rate of interest, either rate of return for short-term investment or rate of borrowing for short-term loan, would be lower as well. But if the time would be longer, then the rate of return and the interest rate would be longer as well. This principle of short-term activities should be analyzed with the overall portfolio in the statement of financial position. On the investment side, which consists of current assets and non-current asset, we would say therefore that the return on the current asset is lower, where the expected return on the non-current assets is higher. It would then follow that if you would like to accumulate more wealth, you think on investing in the long-term assets, which suggests that investment should be more strategic in nature. On the financing side, consists of the current liab and the long-term financing. The cost of current liab is lower, while the cost of the long-term financing is higher. This relationship of current and non-current from the investing side and current and non-current from the financing side entails the basic principle in balancing the statement of financial position, and that is related to the business hedging principle. Let us take a look once more. The components of our statement of financial position are as follows. Total assets is 100. On the investing side, you have a current asset of 20 and the non-current asset of 80. While on the liabilities and shareholders' equity side, you have 80 of current liab and 20 of the long-term financing. The current asset speaks of the liquidity capability of the company, while the non-current asset speaks of the growth potential of the company. This situation in the statement of financial position, though balanced in total, would give us more technical impression in the sense that the liquidity of the company here is understated or lower, while the growth potential of the company would be higher. So they are willing to sacrifice their risk of not able to pay currently maturing obligation as long as they produce more profit. This is a very aggressive working capital policy. It accepts a high liquidity risk, however, with also a high risk for technical insolvency. Let us take a look at another set of our statement of financial position. The total assets and the total liabilities in shareholders' equity are the same, but the portfolio of assets is different now, together with the capital structure that you find on your liabilities and equity side. You notice that you have now significant amount of current assets to meet currently maturing obligation. In short, the liquidity of the company is high. However, the growth of the company is low. The company has compromised their growth and the strategic activities in favor of maintaining a liquidity position. This is a very conservative policy. Low liquidity risk and low return in business. Let us take another statement of financial position. Total assets the same, total liabilities and shareholders' equity the same as before, except that the components of our investment portfolio is current assets 20 and non-current assets 80, while on the liabilities and equity side, you have 10 current liab and 90 long-term financing. This is more a balanced statement of financial position. So we are trying to optimize our liquidity by having available current assets to all the maturing liabilities, and we're trying to optimize our growth by trying to balance the cost of long-term financing with the potential income from long-term or strategic investments. The working capital technique here is moderately conservative. The liquidity risk is minimized or rather optimized. as the components of our statement of financial position is more balanced. So the business hedging principle focuses on how you balance the risk and return in the capital structure and that of the investment of the company. Thank you.